Welcome back to the Investor Professor Podcast with Dr. Ryan Peckham.
This is episode 58, where we'll be covering personal financial ratios.
This is an introduction takeover with Hannah
And Zoe Peckham.
So get your mind right,
And let's get to work.
You dropped this.
All right. Thank you to my daughters for that wonderful intro. Welcome back to the program, everybody. Excited to be with you again for another week here to discuss the market, everything that entails. And yes, what is better than going over some personal financial ratios? I'm not quite sure, but today I'm going to share with you 9 that I think you need to be aware of and how they impact your finances, your future, give you a little bit of a goal to shoot for. And so stay tuned for that. Last week we had a good episode, the obsession episode. Somebody sent me a message and was like, well, what is your point of that? Like, what should be my takeaway from that episode? So if you go back and listen to that, I mean, my takeaway was really that sometimes, if you want to be the leader in your career or the leader in your field, you got to be a little obsessive, and it's okay, right? And you can draw inspiration from those that are obviously obsessed with their careers, and that, there's no end point to it, right? So that's why I like to look at people that are older. Some of the ones that I highlighted that are, year after year still pushing themselves, because as you get older, you'll see a lot of people, peers your age, that kind of thing, that kind of fall off. And so, I don't want to be a part of that crowd. So I refuse to do that. So when we look at the market this week, the market has had a nice comeback over the past month, right? July was the best month since, I don't know where they find this data, but I think July was the best July since 1939. So, I mean, like with COVID, I've said this over and over again, like we just keep hitting records and weird dates, and it's just a weird time, right? So, but if you look, some of the companies that have started to come back a little bit. Maybe we've put in some bottoms. We'll see. I know there's many people that are confused that, man, this economic data doesn't look that great. What's gonna be going on with interest rates? Friday, we had a really good jobs number. There were over 500,000 jobs that were added in the U.S., and that was more than double what was predicted. So the reason the stock market falls on that news, even though it's like good news, bad news, right? So the reason the market was down on Friday, the S&P it fought back, but it started the day lower on Friday, is because with the growth number being so good, the jobs number being so good, there is, that means that there's going to be continued pressure for the Fed to raise interest rates. Right. So the Fed's going to have to keep the pressure on raising interest rates. And so the next time they have the option to raise interest rates, unless they do a special meeting, which I don't think they will, would be September. So, you have part of the, consensus saying that they're going to have to keep raising interest rates. And then part of the other side says, hey, there's a lot of data that has to come out between now and then. The impact of the previous rates has not, made its way through all the way yet. So we'll see. I still and will always be under the camp that if you invest in good companies, all this other stuff, all this noise around interest rate, whatever, there's always going to be something that if you buy good companies, hold on to them, you'll do well. So one of the companies I want to highlight for you is a company called MELI. MELI is the symbol. The real name is Mercado Libre. I believe I've mentioned it before. Last year at this time, it was $1,900 a share. Now it's $1,000. It got as low. It has been just beat to, it has been beat down. It got as low as $612. So it went from $1,900 to $600. That is quite the drop. So this is a company that I own for many number of people, number of clients. I own it myself, full disclosure. And Mercado Libre is the South American version of Amazon.com. But it's also the South American version of Amazon, eBay, PayPal, and they jumped pretty good this week. They started the week, let's see, where were they? They started the week at $800 and they finished the week at $1,024. So they reported earnings on Wednesday, and their financial payments, the digital processing of the payments is really what drove their quarter. And so you look at that and you look at PayPal, the real version of PayPal, and you notice they had a really good week. And so they started the week at $86, ended at $95. They jumped as high as $101. And this is another one where a year ago they were almost $300 a share. So they've lost 66% of their value. And PayPal's been around, obviously, a long time. One of the survivors of the 2000 tech bubble crash by just a week, if you read the book The Founders. But some of these companies have just been so beat up that even though the economic data might not be tremendous, it might not be the best place. I mean, when a company loses 67% of its value, I mean, how much farther do you want it to go down? I mean, some of these companies are down 80%, 90%. And so, again, it comes back to, if you know how, if there's companies that you want to invest in and you understand how they make money, even though they've been beat up, it doesn't mean you can't invest in them. You just need to understand what you're investing in. Because there are some of these companies that, in 3 years, you'll look back and go, man, why didn't I invest in that? And there will be companies 3 years from now that you'll go, man, I'm glad I didn't invest in that. I mean, this is the way it always works. And so doing your homework, thinking about, what trends are going to be like in the future will definitely help you make good, better investment decisions. And so when I look at these companies, PayPal, Mercado Libre, I think about the habits of, I come back to this a lot, right? Human behavior. What are people's habits like? I mean, COVID, one of the things that will stick is that when people's habits change, it really makes it hard for them to change back. And so you think about, an Amazon, somebody like that, where we're doing all these online orders, and that's really not going to go away. I mean, people are going to continue to order things. The younger generation, as y'all grow and you become parents, they're going to just keep doing. I mean, those habits are sticky. And so my only problem with Mercado Libre at $1,000 a share is that now I want it to split like Amazon and Google did, right? So I can accumulate more shares. So anyways, we'll see. As August goes on, we'll see. We have a couple companies that still have to report, but I think we're kind of getting into this kind of lull period where we've had a comeback here. We could have some of these stocks, we could pull back a little bit, but all in all, we'll see. It makes a difference. I mean, if you sold out a month ago, you are already regretting it, right? So it's just, you got to make it through. You don't bail, you just figure out how to make it through. Okay, so this week I wanted to go over different personal financial ratios just so you can start to understand financial planning a little bit better, thinking about where maybe you should be, right? Give some context to how much you should be saving, investing, where you should be spending your money, your debt levels, all of these things. And I think that this is important because, obviously many of you that listen to this are younger, and you're going to be trying to save for investing. You're going to be trying to save for a house. You're going to be trying to save for, maybe a car, paying off debt. Like, how do you start to allocate your own funds in your own life? And what are the ratios you need to be aware of? Because if you go, get a loan at a bank, they're going to look at your debt to, your debt ratios. How much debt do you have? How much income are you bringing in? So I thought that this might be just a nice little lesson to just think about, maybe where you need to be, where you need to strive to be. Because some of these, and I'll point it out here in a minute, like when we go over these, but like some of them, it's going to take you a little bit to get there, just depending on kind of where you're at. So anyway, I'll give you more context to that here in a minute. But so here we go. 9 personal financial ratios you need to be aware of. The first one is just your savings ratio. How much money are you saving? right? So you take the amount of money that you're saving, and you can make it an annual number if you want. You probably should take your savings number and divide it by your gross income, right? So gross income is the amount of money you make before you pay taxes, right? So it's different than your take home. So if you make $50,000 a year gross, right, that doesn't actually hit your bank account. But for this example, you take your savings divided by your gross income, and that will give you your savings ratio. And it should be at least 10%. Now, as we move forward here, you're going to see that, later on, I'm going to recommend it be higher, but at least 10%. You got to be saving at least 10% of your income. So if you make $50,000 gross, you want to be saving at least $5,000 a year is how that would work. Now, where we put that $5,000 is a little bit different. All right, so just also your net worth, right? Just knowing what your net worth is, that is your total assets minus your total liabilities. And so this one, people can massage this a little bit, especially if they have a lot of real estate and they don't really know what it's worth until they sell it. You got your old CD collection, your old Air Jordan collection. I mean, you can kind of put a price on this. So you got to be a little careful with this, when you're guessing at what you could actually sell something for. When I do mine, I kind of take those kind of like little collections out. I don't really include that. So, but you can usually estimate if you have a house, a car, what are your assets, and you subtract that from your liabilities, and that gives you your net worth, and you're really hoping it's a positive number, right? And there are some really good software programs, just some Excel spreadsheets that you can literally go to Google, type in net worth tracker. There'll be a ton of them. You can download them and you can start inputting your numbers, but it's really good just to kind of see what that looks like on paper. Always good to know where your starting point is, because then it gives you a little bit of, something to compare to next year and say, okay, my net worth is increasing. I'm taking the right steps. I'm paying down debt. I'm saving money. I'm, all these things. So it works out pretty well. And so you start looking at, okay, do I need to lower my liabilities? Do I need to increase my savings? Where do I need to make improvements here? So knowing your net worth is key. Even if your net worth is zero or negative, you got to start somewhere. Everybody has to start somewhere. All right. So then we're going to look at your debt to asset ratio. So your debt to asset ratio is one of the main ratios that's going to be used when you go to borrow money. So you look at your total liabilities. Liabilities are things that you owe money on, right? So that's going to be any personal loans you have, which could be student loans, home loan, car loan, any credit card debt that you have, right? Those are your liabilities. That's the money that you owe. And then you're going to divide that by your total assets, right? So your assets would be your investment account. It could be the cash value if you have life insurance, the equity you have in your home, if your car's paid off, what you could sell it for, right? So what are your assets? And then when you look at those assets, you have to look at liquidity. Are those assets liquid? So when we're talking about liquidity, when it comes to money, it's how quickly can you turn your asset into cash, right? So if it's investments, it's going to be very quickly, right? If I wanted to sell some investments, it would take me, I could literally do it instantly. I could have the money back in my account in a day or two, right? So those, our investments that we talk a lot about on this show, those are very liquid versus something like a car, real estate, something that is less liquid that's going to take you a while to sell. So you always have to think about, are the assets that you have, are they actually liquid? Can you turn those into cash quickly? And that becomes a problem when you start talking about kind of collections that people have, maybe art, maybe I don't know, shoe collections, things like that. Things that are a little bit more difficult to turn into cash again. So crypto, I don't know. So looking at your debt to asset ratio, right? Total liabilities divided by your total assets. That is going to be key. All right, so then we have your investing ratio. And this is kind of a neat one, but looking at how much of your investment should be in stocks versus bonds. Now, I will say before we kind of go into this one has been skewed over the last couple of years. So you've probably heard, if you've taken any college classes, they'll tell you to do a 60-40 portfolio, which is 60% equities, 40% bonds, right? That was kind of the old standard years and years and years ago. Well, I'm here to tell you that does not work very well when interest rates are 0%. It does not work very well when interest rates are 0% because you got to get something for your money, right? You've noticed your savings accounts paying you 0.1%. So there's a couple ones here. Like if you're more of an aggressive investor, if you're okay with more volatility, you would take 120 minus your age, and that's how much you should put in to equities. So for example, if you're 25 years old, you would put 95% of your investments into stocks and 5% into bonds. If you're more conservative and you don't like volatility, you would use 100. So if you were 25 years old, you would put 75% in equities and 25% in bonds. Although this is going to get a little bit more in the weeds, but when I look at some of the stocks that I own, I consider some of them like bonds because I'm doing it for dividend income and I don't really have to worry about the companies that much. So, for example, to me, Coca-Cola feels like a bond. I know that there's many people that will argue against that, but I'm just telling you my personal opinion here. I look at some of those companies that, like, the longer I own them and the dividends, they have a history of raising their dividend, like I've discussed on the show, that the longer I own them, the less risky they become because I get so far away from my cost basis and they're paying me so much back on dividends. So, but anyways, that's the investing ratio, and just kind of that one might be good for like your 401k. I mean, if you're 25 years old and your company offers a 401k, you shouldn't have 50% of it in bonds. You shouldn't, right? And this is why some of those age-dated funds have become so popular, because you just tell them, I'm going to retire in 2085, and it kind of takes care of it a little bit. That's why those have become so popular, because as you get older, those become more conservative. Now, one of the problems with those have been that if you haven't started saving, like let's say you're older and you're 50 years old and you use one of those age-weighted funds, but you haven't been investing, it's probably not going to be near as aggressive for you to try to catch up, because you're going to be putting money in there and it's going to be very conservative, especially as you get older. So you have to be careful using those as well. Passive income ratio. So this is one I like, not one that a lot of people have heard of, but passive income is really what we're trying to get you to do, right? If you build a portfolio, whether it's an investment portfolio or real estate portfolio, and you have money coming in while you sleep in the form of dividends, rent, whatever it is, that is passive income. That is income that you don't have to go to work work every day to produce, right? That's income that's going to be produced just because you planted a tree a couple years ago. So that passive income ratio is, you look at what money do you have coming in, right? Your passive income that you haven't worked for, and you divide that by your primary income, which is your primary job. Now, your target for this, man, wouldn't it be nice if you could hit 50%? So if you're making $50,000 a year and you have $25,000 a year coming in passively, or if you're making $100,000 a year, you make $50,000 passively. Like, this is where you want to get. This is where you want to get to. Now, obviously, many of us are not going to be there, and especially if your salary raises, if you get raises every year, it's going to be tough to do that for a while. But that should be your goal. How can I make 50% passively versus what I'm making by showing up to work every day. So that's what we're after. Another one is your personal cost of debt. And this one is very confusing to do via podcast without like writing it down. But when you look at your personal debt, which could be credit cards, student loans, any other kinds of loans, how much are you paying on that debt? And the reason this is important is because the stock market has averaged around 9%. If you're good, most people don't get 9% because they're in mutual funds that charge them fees. They trade too often. So it's kind of a misnomer that, people actually get the 9% that the stock market has actually done. Let's say that the average person gets 6 to 7. Well, if the average person is getting 6 to 7, then they are not your personal cost of debt is probably going to be a number where you need to get that personal cost of debt down so that it actually, because it's not worth it. You're not going to make as much in the stock market as you are paying on your debt, especially if you have a lot of credit card debt. Student loan debt is usually a much lower rate. Car notes are usually a much lower rate. So if you have a high credit card debt, you really need to understand what you're paying on that. It's shocking to me, but most individuals do not know if they have a student loan, what their interest rate is. If they have, a car note, what their interest rate is. Credit cards, what their interest rate is. They don't know. They just know what their monthly payment is. And that's kind of where we really get, nobody cares what they're paying on the money as long as their payment is $4.99 a month. And so you got to be more aware than that. You got to be smarter than that. You got to protect yourself because nobody else is going to protect you, right? There's a lot of people who make a lot of money off of the ignorance of others. So pay attention to what you're actually paying on your personal lines of debt. And then you can kind of just Google that formula, but the personal cost of debt, because you got to look at what percentage of your debt and divide it. And it's just too complicated to do on a podcast, but be aware of what you're actually paying for the money that you take out. All right. So if you've made it this far, I'm proud of you. I think you're really going to like this next one. This is the 20, 30, 50 budgeting tool. So this is okay, but how much should I be saving? How much should I spend on something? How much should how much is life going to be? So this one is less complicated, easy to understand, and here it is. You take 20% of your income and you save it. And from that 20%, you're going to put part of it into investing, part of it into retirement, part of it into saving for a home or whatever. If you got big savings goals, you're going to take 30% of your income, and that's what you're going to spend on housing, right? Don't spend more than that on your rent or your mortgage. And then the other 50% is just for life, right? So, for example, you make $5,000 a month. You're going to take $1,000, and that's going to be your investing / retirement, emergency fund, any savings goals you have. Maybe you're going to pay down some debt with that, right? So you take $1,000, and that's where that goes. You're not going to spend more than $1,500 on your mortgage or rent, and then no more than $2,500 for everything else, which is utilities, food, entertainment, those kind of things. So that is a very good starting point for many of us, 20, 30, 50. Now, depending on where you live, your area, cost of rents are different things like that, right? Maybe you're going to have to pay a little bit more for rent, but maybe you can save that on entertainment. So, but just kind of look at what you're doing and then compare it to that and kind of see where you're at. Next one is life insurance ratio. Boy, are we get into the good stuff. Life insurance ratio. So if you don't have any dependents, this really isn't for you. But normally, if you're younger, let's say you're 25 years old, you can get 20 times your annual income in life insurance. So if you make $50,000 a year, they'll allow you to get $1 million worth of life insurance. because that's what life insurance is for, is you're trying to insure the life. And if you're younger, you have a lot of working years ahead of you to produce that income. And $1 million, if you made 5% on that, would produce $50,000 a year, which would replace the person's income. So this one is definitely more tricky as far as if you have dependents, if you have children, how much longer are the children going to be in the house. But life insurance is cheap enough that especially if you have dependents, there's no reason for you not to take care of this. Zero. And then here's one that I'm going to end on, the ninth one. I guess I should have been counting these down. I'm not very good at that. But the net worth ratio, and this one comes from the book, The Millionaire Next Door. Okay, so if you want to read more about this one, go pick up The Millionaire Next Door. It's a great book. Just talks about what the average American millionaire looks like. It's a lot different than you think. But this one gets pretty aggressive. So I'm just going to tell you, but this one is like, okay, where do you want your net worth to be based on your age? So if you take your pre-tax income and you divide it by 10 and then times it by your age, that should be your goal. So if you're 25 years old and you're making $80,000 a year, you would take 25 times 8,000, which would give you $200,000. Right? That's where you would want your net worth to be. Now, for many of us, this is going to be a very aggressive number that you're probably not going to be at when you run it for yourself. But it's something that maybe you should strive to do, especially if you've had big jumps in income over the previous couple of years and you really haven't been making that income for very long. Maybe you've only been making that income for a year. Obviously, that you're not going to be able to be here. But it's something for you to strive for. You would be in the top 1% of your age group if you hit this. So top 1% if you hit this. So those are some financial ratios for you to be aware of. I encourage you to just kind of, if you're bored on a Sunday or a Saturday, to start looking at this, but you have to start tracking where you're at and know where you're at so that you kind of know where you're going, right? You got to have a roadmap. And so that is the point of this lesson today, is just kind of take a seat, look at where you're at financially so that you can kind of look and see where you need to go. But I felt like, because we don't really talk about specific situations, this would allow you to be able to kind of look at where you're at and where you're starting from, or where you're trying to get, to give you kind of that financial planning roadmap on where you should look to be. So if you have any questions on that, obviously you can use the SpeakPipe app. You can send me a message. I can provide some clarity and answer specific questions. So that's going to be it for this week. Next week, I've already done. We have Bridget with Sleepopolis is going to do an interview with us on how to get better sleep. So I'm looking forward to that episode. I think that you'll enjoy it as well. So I appreciate your time. I hope you have a great week, and I'll see you next time.